A corporate transaction moves seamlessly through a business until the moment it is intercepted, misdirected, or bleeds out due to an internal system failure. Internal control functions as a continuous feedback loop, providing the constant measurement and correction necessary to accomplish specific organizational goals. This loop follows 4 distinct steps. Management must establish standards for an operation, measure performance against those standards, analyze any deviations, and then take corrective action. Building this system has a strict economic limit. The cost of an internal control must never exceed the benefit it provides to the organization. Even within that budget, a perfect system is impossible. Experienced employees can evade established rules, and collusion between individuals can override nearly any safeguard. To survive these vulnerabilities, an organization must build a resilient architecture from the ground up, layering structural segregation, primary operational controls, and an overarching IT infrastructure. We can map out this architecture using the purchases payable cycle, the process of acquiring goods and paying vendors, as our baseline scenario. The core operating principle here is the segregation of duties. A single individual cannot have unilateral control over all aspects of a transaction. This diagram illustrates how a transaction is split into 4 distinct functional responsibilities: authorization, record-keeping, custody, and reconciliation. Looking at the authorization track, inventory control initiates a purchase requisition, but only the purchasing department has the authority to execute that transaction. Once authorized, data moves to the record-keeping track. Accounts payable logs the transaction details, operating entirely separately from the personnel making the purchase. The physical assets then arrive on the custody track, where the warehouse takes secure possession of the inventory. Finally, the reconciliation track closes the loop. Inventory control performs periodic checks to ensure the physical count in the warehouse matches the recorded accountability in the ledger. There is a strict rule governing reconciliation. It must be performed by a party entirely unconnected to the original transaction or custody of the assets. Structurally isolating these 4 functions means that committing fraud or hiding an error requires coordination across different departments. The separation of human roles becomes the primary systemic defense. With the macro structure established, we need to examine the individual operational nodes located along these tracks. These nodes are secured by primary controls, functional barriers categorized as preventive, detective, and corrective. Preventive controls operate first, designed specifically to stop unwanted events before they happen. This includes physical segregation, locking petty cache in safes, or database edit checks that automatically reject letters entered into numerical fields. When prevention fails, detective controls alert management that an unwanted event has occurred, ideally before material harm is done. Examples include reviewing system logs for repeated failed logins, or using hash totals to verify that an entire batch of data has been processed completely. Corrective controls then step in to reverse the negative effects of those events. Operations like restarting from system crashes or requiring management to officially justify specific cost variances fall into this category. If these primary controls fail or are unfeasible to implement, organizations rely on secondary mechanisms, like close supervisory review, to compensate for the exposure. The ARCR matrix maps the theory, but these primary controls create the operational friction that actually stops risk from flowing through a business cycle. Modern business processes rarely rely entirely on manual, paper-based segregation. They rely on system-based, automated execution. This introduces a critical vulnerability. Centralized computer systems inherently collapse manual separation. A single machine might now authorize, record, and reconcile transactions simultaneously. To secure this environment, this diagram shows how controls must be bifurcated into general and application layers. The outer shell represents general controls. These govern the entire IT environment and the physical infrastructure. They enforce data center operation protocols, secure software acquisition, and broad access security net-wide. A strict access security rule, for instance, dictates that software developers are completely prohibited from having online access to production databases. Inside that shell are application controls, specific to the individual software programs processing the actual data. These ensure that only valid, authorized data enters the system as input, is processed properly, and is reported accurately as output. Operating beneath even the software layer are hardware controls built directly into the equipment by the manufacturer. Mechanisms like parity checks run continuously, identifying errors during data transmission across these hardware lines. Echo checks confirm the data was accurately received, while read-after-write checks verify storage integrity. IT automation does not eliminate control risk. It shifts the battleground from physical duty segregation to systemic, automated access limitations. As this entire system operates, it produces tangible outputs. Transactions leave behind documentary evidence as business is conducted. This evidence relies on sequentially pre-numbered forms, such as receiving reports or purchase orders, to map activity as it travels through the matrix. Pre-numbering establishes complete accountability. If a sequence number is missing, the discrepancy is instantly flagged for scrutiny during reconciliation. Auditors utilize this documentation for tracing, following a transaction forward from the triggering event to the resulting accounting record to ensure completeness. The reverse process is vouching. This follows an accounting record backward to the original source document, proving the recorded transaction is fully supported by facts. Strict document routing protects this trail. Authorizations for uncollectible account write-offs, for example, are never routed to cashiers, preventing the theft of incoming funds. A rigorous internal control architecture relies on structural segregation via ARCR, functional barriers via primary controls, and comprehensive protection through IT general and application rules. Because these mechanical and digital layers still rely on human execution, an organization must implement an evaluation reward system to create a tangible incentive for compliance. Systems can be engineered with precision on paper, but when 2 or more employees coordinate to bypass these layers, the entire architecture can be neutralized. Monitoring this human element remains the final, necessary layer of the control process.